All right, everybody, it is that time of year again. We're talking 2025 tax-free savings account contributions, and I just want to make a little video over the holidays here. I'm not quite getting fully back on the channel, still kind of enjoying some time off from Stocktrades in general, but I did decide to make a video today kind of lining up how I'm going to be spending my 2025 TFSA contributions. I'm going to be going over the 3 stocks that I will be buying at the start of 2025 in my TFSA with the contributions. Obviously, it's a small portion of my portfolio. It's just the annual contributions, but I felt it would be a pretty good video nonetheless. One thing I do want to mention before I begin is the fact that we are running a promotion over at Stocktrades Premium right now. We ran this promotion actually just after Christmas. However, I realized that I have not put out a video since. So even though the deal is closed on that side of things, I'm going to open it back up for one more day if you would like to sign up for that platform. It's a pretty good price to get in there for the year. You can see my portfolio, all my returns, my transactions. I put out a weekly newsletter. I got stock screeners, a private Discord. I have a Q&A. It's one of the best platforms and one of the best priced platforms. I can absolutely guarantee that in the country. So if you want to join that, I will leave a link in the description. The deal will be open for today only. I'm shutting it down at midnight tonight. So let's get right into the video. This won't necessarily be an in-depth analysis on each stock. I'm going to go over why I'm buying it, maybe, a point or two from the quarterly earnings. Just kind of make this a quick recap of the 3 additions that I am going to be adding to the portfolio. So the first one is BRP. So they trade under the ticker DOO.TO, and this is a very high quality business that is in a big rut due to high interest rates. So BRP, it would be Bombardier Recreational Products. And the one thing that a lot of people don't understand is this company has nothing to do with the Bombardier, like the actual Bombardier company. This company was a spinoff, I believe it was back in 2000. So it has nothing to do with Bombardier. It's a completely separate company. A lot of people, they kind of have a negative stigma against Bombardier, and so they kind of assign this to BRP. It has nothing to do with Bombardier. It's a completely separate entity. So they have been going through a bit of a rough patch here after COVID-19. I mean, we can go down, we see revenues down 18% year over year. We see earnings down 68%. So what ended up happening? I mean, obviously, during the COVID-19 pandemic, interest rates, they hit, absolute lows. And as a result, a lot of people finance vehicles like this. And not only that, a lot of, excess capital was flooded into the system. A lot of people had a lot of extra money. So as a result, they were buying recreational vehicles. In addition to this, there was a lot of lockdowns. Not a lot of people had stuff to do. So, they could do this. They could buy a recreational vehicle. They could go off-roading. They could go snowmobiling. They could go, sea doing, whatever the case may be. Those would be the key products that Bombardier does make. And as a result, earnings absolutely skyrocketed. I mean, even if we look to earnings before COVID, we're looking at around $3.54 a share. If we fast forward to peak pandemic, we're talking $9.42. And if we get to the end of 2022, absolute peak earnings, we're talking, $12.50. So think about cyclical stocks. They're going to be cyclical. And if you're going to buy these companies, you need to be willing to take the lows with the highs because they tend to happen very fast. When we look to 2016, we're looking at, lows of $15 a share. And by 2018, we're looking at, $70 a share. So that's almost a 5x in price over, the course of 3 years. These cyclical stocks, they're going to have a lot of ups and a lot of downs. And I do believe right now is a down for BRP. Interest rate declines should help the company, but it is not immediate. Let's look to the declines in 2015. I mean, they dropped rates quite a bit here, as you can see on the left. The company's stock price went down quite a bit. The only, it didn't end up actually doing well until, 2 years after those rate declines, and then it did very well. And we can see here when interest rates started increasing, it's a lagging effect. It's going to be a lagging effect when they come up, and it's going to be a lagging effect when they go down, except when you get, a panic type situation on the way down here during the COVID-19 pandemic. If we go down to the company's actual report, we're seeing 22% declines in revenue, 32% declines in gross profit. We're seeing free cash flow down 71% despite capital expenditures being down 9%. So it's been a really pretty rough time, but I do believe that the times to add to these cyclical options are often when, times are the roughest. We've seen the company mark down guidance quite a bit over the last while. They did not mark down guidance last quarter, which kind of leads me to believe that they do understand where the market is moving forward, and they're more comfortable issuing, guidance and sticking to it. So when we look at valuations, this is probably something that might confuse people. We see 28x trailing 12-month earnings, and the stock looks to be pretty expensive. However, cyclical stocks, it's not always a guarantee, but it will often work in the reverse. The times to add to cyclical stocks are often when PEs are high, and the times to avoid them are often when PEs are low. So this is, it's the complete reverse of what many investors have been taught: buy at low price to earnings ratios and sell at high. But the thing with it is, cyclical stocks, the market is always forward looking. So when you see a company that is trading, a cyclical company like BRP that's trading at a very low price to earnings ratio, what this is telling you is that on a forward looking basis, the market believes we're in somewhat of an economic peak. So if a company like BRP has $12 in earnings per share and is only trading at $100, that's what, 8.5, 9x times earnings. The market is effectively saying that this is likely the peak earnings. So that would indicate a low price to earnings ratio because the market expects earnings to decline moving forward. When we get to an earnings ratio, of nearly 30 here, I believe the company is expected to earn around $4 a share this year. When we look here, $4.50. When we look to share price of $72.56, we can see that the price to earnings ratio is very high at this point. And, from a cyclical perspective, the market is trying to say that the environment moving forward is likely going to improve. This is why we see the company trading at 14.4x expected earnings. This high price to earnings ratio is reflected in trailing 12-month earnings. And what the market is trying to tell you there is earnings are expected to go up. So the market is pricing in a bit of that right now, and that's why you see that high price to earnings ratio. I hope that helps clarify this. If you have any questions, just drop it in the comments down below, and I'll do my best to answer. But BRP, that is the first edition. Now, the second edition I'm going to be buying, and this is going to be a very controversial one because these are probably some of the most hated stocks in the country right now, and that is TELUS. So why am I adding to TELUS right now? We're sitting at 52-week lows. The market is up 25%. It seems absurd to add this company right now, but often, again, the same with BRP, often the best time to add these companies is when the environment is the worst. And right now, I do believe that telecoms are being beaten down. In the case of BCE, it's just horrible operations. I do not like that company. I haven't liked that company for quite some time. I've kind of expressed my dislike for the company on the TCI podcast, previous videos, through my newsletter, whatever it may be. But with TELUS, I do believe there's an opportunity here to add a company. For me, this is not a long-term hold. This is something I plan to hold for the midterm just based on the valuation multiple expanding. I think the company is just too cheap right here. So it's expected to earn around $2.3 billion in free cash flow this year. Next year, I would expect with capital expenditures trending downwards. If we look to the financials of the company, we go to the cash flow statement, you're going to see a trailing 12-month decline in capital expenditures. We can see even in early 2023, they came in at $3.61 billion. We're trending downwards to $3.4. I would expect that this could come in around $3 billion next year. It could possibly come in even lighter than that. And as a result, as long as the company can continue to grow operating cash flow, which as we can see over the last while, 4.4, then we got 4.5, 4.7, 4.9, 5.1. If the company can continue to do this, it's likely to generate, I would say on the low end, $2.5 billion in free cash flow in 2025. When we look at a market cap of $29 billion, this would signal that it's only trading at around 11x that expected free cash flow in 2025. Obviously, they haven't released any sort of guidance yet. That will come in Q1. But that would be a relatively conservative estimation on my end. And as a result, I just think 11x is a bit too cheap. These telecoms have typically traded at much higher valuations than that. So I'm going to buy the company. I'm going to just sit on it, hold it, if that does, if the valuation gap there comes to fruition, I will end up selling the company, taking the profits. Obviously, it's never a guarantee. Interest rates could remain high. Bond yields could remain high. And the one thing I will say with TELUS moving forward is a lot of people expect interest rates to help these companies immediately. They expect, why aren't companies like utility companies, telecoms, why are they doing that well in a falling rate environment? And that is because bond yields are not moving all that much. So if we go to year-to-date bond yields, the Canada 5-year bond, this is going to be the benchmark for a lot of financial institutions when it comes to lending. So if you have a mortgage, for example, a fixed rate mortgage, and it's at a higher rate, and rates have fallen 150, 175 basis points this year, and you're sitting there with your fixed rate mortgage up for renewal, and you're like, why have fixed rate mortgages not come down 175 basis points, 1.75%? It is this 5-year bond that is the reason why. This is what the banks will use often as a risk-free rate, and then they will lend over and above that amount. So if they can get 3% risk-free, obviously there's going to be a premium attached to lending. So maybe 3%, this is just numbers completely right off the top of my head. They say we can earn 3% absolutely risk-free. Let's make fixed rate mortgages 4%. There's a 1% premium over that, 5-year bond that they could lend at. Obviously, the mortgage is tied to a house, so there's an asset there. They don't have to take as large of a premium as, let's say, a vehicle loan. That, a depreciating asset like a vehicle, they would have to assign a higher premium to this. This works the exact same way with companies, high debt companies like TELUS. I mean, we look to the debt. We're talking $28 billion in debt. BCE, I think we're talking in the range of $40 billion in debt. They have to refinance that debt. And ultimately, if the 5-year bond rate doesn't come down, this is going to be, even though policy rates have fallen 175 basis points, this is going to be the judgment of their refinancing rates. So we saw, as we can see here, the 5-year bond peaked at around 3.85% in 2024. We come down right now, we're sitting at 2.9%. So, just quick off the top of my head, that's 0.85%. Rates have fallen much, much more than that. So this is why you're not seeing, first off, fixed rate mortgages fall all that much. And this is also why you're not seeing interest sensitive companies benefit as much as you would think. Now, I do believe that this will normalize. We're likely, I'm not going to say guaranteed, but we're likely to have an early election here in Canada. A change in government could maybe, give a little bit more bullish sentiment towards the Canadian economy, because to be honest, it can't get much more rough than it is right now. But I do ultimately believe that TELUS will see a bit of valuation expansion. It's never a guarantee, obviously, with the headwinds they're facing right now in terms of the scaled back immigration. But I do believe that there will be valuation expansion. I'll look to sell when or if that even happens. Again, I could be wrong here. Far from guaranteed. But that's another one I'm adding. And the third one I'm adding, and I won't actually go too much into this company. Instead, I'm going to link to a video that I did, I believe it was a week or two ago. This was one of my best performing positions in 2024. And I'm continuing to add to that, and that is Well Health. They are a digital healthcare company. They're often pegged as a pure digital healthcare company, but they have a lot of physical clinics as well. This is a company that's made a lot of acquisitions south of the border. They're growing in a much more profitable U.S. healthcare space, but they also do have a ton of Canadian exposure. They're a small cap company, $1.75 billion. Plenty of room to grow, in my opinion. If we look to the quarterly highlights, again, I go over this much more in depth in the video I linked to previously, but I'll throw one in the description as well. We're looking at a 23% year-over-year increase in revenue, 16% in EBITDA, nearly 70% in free cash flow available to shareholders. Now, this was one of the main drawdowns for Well Health moving forward. A lot of people were concerned about profitability. The company was dumping a lot of money, issuing a lot of shares in terms of, fueling these acquisitions, especially ones south of the border. So profitability was a main concern, which is why the stock, it went next to nowhere for quite a few years. I've owned it for longer than that. I didn't necessarily buy it at peak pandemic prices. I believe my average cost is in the $3 to $4 range. And a lot of that comes from accumulation during this down period. I added a lot of shares during that period, which ultimately has vaulted my gains at this point in time. But I do believe the company will be continuing to grow. It's making smaller acquisitions. It's not going for those large-scale acquisitions that it did during the COVID-19 pandemic. But the one thing we need to understand as well is this company was raising a lot of equity during the pandemic when share prices were at all-time highs. This is not necessarily a bad thing. Raising equity at all-time high prices, you get a lot of bang for your buck. You get, it's more beneficial to raise equity here than it is down here. So obviously, there is a section in here in terms of share count, but the company is scaling back its share count by quite a bit. So they're moving from share-based compensation to cash-based compensation. Obviously, this is going to be due to the fact the company is more profitable at this point in time. So they're not going to do a ton of share-based compensation, which tends to absolutely bury companies like this. I mean, they don't have a lot of, cash flow to pay employees, to pay upper management, things like that. So they dish out a lot of share-based comps, and that angers a lot of people because it does dilute shareholders. Now that they're becoming profitable, I mean, we can see, this is reduced by quite a wide margin. And then we look to the overall share dilution, which has decreased quite a bit as well. We can see in 2022, they diluted 10.2%. Obviously, still making a lot of those acquisitions, still fast growing. In 2023, they scaled it back to 4.4. 2024, they're going to reduce that down to 3.4%. So as profitability is coming, less share dilution, and overall, more free cash flow available to shareholders on a per share basis. So again, not going to speak on Well very much. I will link to the video in the description. You can see my, it's a 20-minute video laying out my overall thesis for Well Health, why I really like the company. So overall, these three companies, I'm adding them in my TFSA in 2025. They're all relatively small positions for me on an overall basis. I mean, I believe TELUS would probably be the largest position at 2% of my total portfolio. I believe Well Health is in the 1.5% range, and BRP is in that, mid 1% range as well. They're not core positions for me. In terms of TELUS, it's more of a midterm speculative valuation expansion. BRP, bottom of an economic dip in my opinion, so I'm adding right now. And Well Health, one of my more bullish small caps moving forward. Everybody, as always, if you like the video, head down below, like the video, subscribe to the channel. We're getting close to 19,000 subscribers. Would love to hit it before 2025. I don't think it's going to happen, but you can help make it happen. And as always, that premium promotion, I'm opening it up for a single day and a single day only. You can head down below to the description, sign up for that. Great discount off your first year and also a lifetime discount. And drop a comment. Let me know what companies you're buying with your TFSA contributions in 2025. And as always, everybody, we'll see you next time for more great Canadian content.